Okay, hi everyone. This is Rohit Shrivastava here. I'm the founder of INDIACHARTS.com, a blog that I've been writing since the year 2000. However, I've been involved with markets since as early as 1990, starting with a full-time working career in 1994, did my management between 97 and 99, and then worked with a proprietary firm, after which I spent almost 18 years with Sher Khan, a popular broking house that most of you would be aware of. But simultaneously, I continue to write INDIACHARTS.com, which is my blog, and is now a paid newsletter. So anybody at the end feels interested in the newsletter itself can actually, visit India Charts. This is the website which you can see on the screen. So you can visit it. And if you want to sign up, there's of course a free newsletter sign up down here. And you can also consider the paid letter which we send out on a daily basis. I write a weekly note on every Sunday, and I write the long short report, which is my strategy note. Part of today's discussion goes into the strategy note, which is all about the reflation trade, which we've discussed in the month of May. And so you'll get an insight into what we have been thinking on that front, try and look at a couple of indices and sectoral trends that are likely to drive those moves. So that's the object of today's whole discussion. So of course, if you're interested, you can simply go here and have a look at this. Now I'm going to quickly take you to my slide presentation. The way we are going to start, this is about Elliott Wave basics. So if you're really not aware of Elliott Wave theory, you're going to get an insight into what it is, how the basic form, the fractal form of Elliott waves develops, and how we then represent that on charts to actually show you what the likely trend and outcome is going to be. Okay, so it's a very interesting field. Some people think it's way above the head, but actually the simplest in terms of the thinnest book that you'll find on any part of technical analysis will be Elliott Wave Principle by Frost and Prechter. In a small little piece, he ends up explaining what is a very detailed analysis of the only means of market forecasting, and implementation really takes an entire day. So you have to, day-to-day basis update what you call our wave counts, and when you do that, then you're able to get along with knowing how the market is going to do. So that's the crux of it. So it's a lot of work. The theory itself is simple and short, and you'll get into the basic idea of it, whereas the work is a day-to-day piece that you have to do really to get at the end of it. Okay, so what is Elliott Wave theory and what is technical analysis? Basically, the way I look at markets is complete market analysis, put everything together, which means that it's not just about technicals, it's combining technicals with fundamentals, combining technicals with economics, and understanding that. And that understanding doesn't come with Elliott waves because it's also a behavioral science. Whereas most of technical analysis, which is classical technical analysis, is more of a trend following or trend analysis part of the science. So when I would actually try to put even that together. So I don't say that this part is not useful or that part is not useful. It's actually knowing how to use the complete science that is really useful. And I think that's what you need to be able to really do. So who are the founders of all the sciences and technicals? It's of course Charles Dow. Dates way back to the early part of the 20th century, and his introduction of the Dow indices allowed us to start mapping markets across different themes. And he had these couple of indices: the Dow index, the industrials, the transports, and then came up with basic price theory. So he determined what is a trend simply by saying that if you are looking at a trend, if it moves up, making a higher high and a higher low, and then another higher high and a higher low, you would end up calling that a trend. Now, that basic thought process led to the development of a lot of theory around trend analysis. It led to people coming up with indicators, calculations that try to determine what is the trend based on those calculations. But all the calculations come down to basic things, which is price and volume. So you're simply doing price volume analysis by looking at charts, and you're trying to determine what is the trend. Now, the other thing he did is he said that trends move in three different phases. There's the primary phase, the secondary phase, and the blow off phase, which is the bubble phase also. and he defined each of these trends. The similarity it had with Elliott waves is what we will really end up seeing, because when he said there's a primary phase, he said that's the first wave, the market moves up, and then from a completely depressed environment, and then you get a reactionary trend, and then you get a second wave where people are more confident about growth and a turnaround in the economy, and then you get an unexpected correction even after that, and then you get the final phase, which is the blow off move. Everybody starts to participate, gets overconfident, and the market peaks, and then you get a bear market. So this was his definition of the phases of the market, and uh, all that gave a lot of input to how we should really look at markets. So the entire field of classical technical analysis which has come out of this ends up being more trend following in nature, because it's continuously looking at where the trend is, where it's likely to head, and what people are likely to expect. But it's less of a forecasting tool. So this is the big difference between Dow theory and Elliott Wave theory, is that Dow theory became, if the trend is up, the trend is up, and the trend is not down unless the trend is down. Now, that's a little difficult to follow for some people. Of course, if you're following the trend, it's great. If you have a trending market, but how do you really know how far the trend is going to go? And that's what was missing in Dow theory. Where Elliott Waves came in is that it was able to actually do market forecasting. So that's, I think, the big differentiator between the two parts of the science. One is a trend following tool. It gives you lots of means of analyzing what the trend is, but it doesn't really tell you how far it's going to go, where it's going to end, what part of the larger big picture scenario is this trend. Although he has given you phases, there's no way to really measure those phases. And I think that's where R.N. Elliott's work, around 20 to 30 years after Charles Dow, was the second person whose contribution to the field of technical research really became big, because he came up with a fractal. He was, of course, Eyal Ritter came in from Mexico into the US and started to study what uh, patterns repeated and felt like. So he studied a lot of US data, and then he found repeated patterns, which he called the Elliott wave fractal, and he on which is better now referred to as Elliott wave principle. He also wrote a book called Nature's Law, because he found that the Fibonacci ratios and structures that he was actually looking into were found in large parts of nature as well. So it became a very deep science. Later, it has been associated with also behavioral trends and social science itself, in the works of Robert Prechter, who actually picked up the work of R.N. Elliott and then put it into his book Elliott Wave Principle, which is what we use to read and study. So anybody wants to learn Elliott Wave analysis, that's the go-to book, Elliott Wave Principle by Frost and Prechter, and a 200-300 page book that and less than half of it is actually towards just understanding the basic setup of Elliott waves, which is that a trend basically moves in 5 waves and pullbacks in 3 waves. This simple theory and how it works, uh, along with some rules and guidelines, of course, because you cannot have a system which does not follow rules and guidelines. So it was very specific in terms of the structure, and the structure repeats again and again in history for a particular reason. So when you're studying an index is made up of 30 stocks, 50 stocks, 100 stocks, which make up the largest part of the market cap of the market. So which means you're actually studying a large number of investors who are invested in those companies, their movements and their behavior. So you're actually studying the behavior of a very, very large mass or a large audience. So essentially what it comes down to is that we are studying mass behavior, and mass behavior or psychology tends to be not only repetitive but also has the same reflex in a given environment. So if you put two masses of people in two different locations, and give them the same external stimuli, likely outcome is going to be the same. It's not going to be any different. And that's the driving force between study of masses. The reason you have a repetitive fractal or pattern over and over in time, which allows us to predict, is because you're actually studying the pattern of large audience or large mass of people that are being exposed to daily news, events, fundamentals, economics, and all kinds of stuff which is going on. So it's not just the fundamentals of the company and the business cycle. It's like the entire news and their life that they're really exposed to in the economy, that really reflects in their behavior in financial markets. And so the way Prechter put it is, in his social mood study, he's called that socionomics, an entire study that looks at various behavioral trends in society, everything from trends in music, trends in movies, and relate them with what is really going on in the Elliott wave fractal. At what stages of the larger structure you find different patterns repeating in terms of political choices and so on. So that's why it's extremely deep behavioral science. But it's a simple use which we end up doing as financial analysis just to predict where markets are going to go. Because once we know that, okay, markets are patterned because they're showing the behavior of all these people in response to what they are facing on a day-to-day basis, then we know how to read that behavior. Okay, and this behavior repeats not just at one point of time, but it repeats in at every degree of time. So you can actually apply the analysis on a daily, weekly, monthly, quarterly, yearly, and decadely time period. Okay, so markets move in trends. Long-term trends can be made up of several cycles, as was also stated by Charles Dow. But now with Elliott wave analysis, we have a model to really be able to forecast and have a plan in terms of what we expect the markets to do. Okay. Now in Elliott wave theory, what we are trying to figure out is the trend, and the wave theory holds that all price movements move in the direction of the major trend in 5 waves and counter to the major trend in 3 waves. Okay, I said in the direction of the major trend. Now the major trend could be up or it could be down. Okay, so every move in the direction of the major trend ends up being a 5-wave move. So if the larger trend is up, which is what the arrow is showing, then all moves in the direction of that trend are going to be 5 waves up, and it's going to be 3 waves down. Similarly, if you have a larger trend which is on the way down, then it is going to be 5 waves down and 3 waves up. So the movements are going to be 1, 2, 3, 4, 5 down and ABC up. Now this is putting it very, very simply. There are certain rules and guidelines with which we mark 1, 2, 3, 4, 5, which we will soon come to. Okay. The thing is that if the larger trend is up and you're going to move up in 5 and you move down in 3, what happens after you move down in 3? Simple answer, you move up in 5 again. So the great thing about this is, and how it becomes a very, very high probability forecasting model is, say that the markets are falling continuously. Okay. And then one fine day, you're able to spot this 5-wave move up. What does it mean? It means that the trend has changed. It means that the trend has changed from down to up. Not only that, once you spot another ABC pullback, it's going to move up in another 5 waves. And this is where it becomes a high probability trend. Many people actually like to trade that, trade a pullback after a impulsive 5-wave move, because every 5-wave move is what we call an impulsive move. And once you get an impulse, then you expect another impulse after a pullback, and that's what they trade. It's also known as trading the third wave. A lot of people who don't want to take the burden of really picking that low point in the market, they simply wait for this to show up and trade the third wave. And so they end up getting a very, very high probability trade setup in that sense. But as I said right at the beginning, these fractals show up at various degrees of time. The entire trend subdivides into a 5-wave structure, not just on the daily chart, but on the weekly chart, monthly chart, quarterly chart. And the way it does that is that the initial 5-wave is also the first wave at a larger degree. So you find 5 waves on the daily chart, it may be a larger first wave on a higher time frame. Then you get a second wave pullback, you get a third, so the next 5-wave is a third and a fourth and a fifth. And similarly, this entire 5-wave rise that we are seeing will be a first wave at a still higher degree of time. So you could have a 200-year trend going on in 5 waves. So you typically a 5-wave move which is 50 to 80 or 100 years long is called a super cycle, and something which happens and then that super cycle is the first wave. Then once you have 3 super cycle waves, which is a 1, 2, 3, 4, 5, a 5-wave structure of multiple super cycles, that ends up being a grand super cycle, then can last 200 to 300 years. So that's the big picture way of really looking at it. You can go to any degree of really mapping this trend. And just as after a 5-wave the trend turns down, what do you get? You get a 5-wave move down. We typically call that a wave A. This again occurs at every degree of time, so which means that even if we are looking at this A wave of the third, that itself would also subdivide into 5 waves, just the way I've shown it here. And we would mark that as A. Then you get a pullback in B, which is usually 3 waves against the trend, and then another 5 waves down in the direction of the trend. So this is the framework with which we work. We do everyday Elliott wave analysis on every degree of time, so that you can really get to know where markets are headed, and pick up the most high probability trades out of it. But then how do you mark this 1, 2, 3, 4, 5? How do you just do it? Because a lot of people now learning Elliott wave analysis online end up doing it randomly. Some of the understanding of the basic rules and guidelines is also not complete. What I will go over is some of the rules. I can't go through all the guidelines, but the difference between rules and guidelines are that rules are rules. They cannot be really broken, and guidelines are generalizations. It's very important because people do mix up rules with guidelines. They read a guideline and they think that's a rule and then believe that it should be applied always. But a guideline is just something that occurs 80% of the time. Okay. So the art of Elliott wave analysis is essentially what I call the art of elimination. Okay, once you know the rules, you use the rules to eliminate that which is not possible. This is a very important understanding in being able to apply, because people start thinking of Elliott wave analysis as exacting, which is that it's supposed to tell you exactly what is supposed to happen. There's no such thing as exactly, but it can tell you something that is highly probable, or it can tell you two different things that can happen, maybe not more. You can come down to two possibilities which are the most probable outcomes, rather than end up thinking, oh, it can go up or it can go down. You can actually think that, okay, the best case scenarios, it's likely to go up, or it's likely to only dip so much before it goes higher, and so on. And so you can have one or two or three possible best outcomes. Usually you can come down to two, but to come down to those two, you'll have to eliminate that which is not possible using the rules of Elliott wave counting, right? So that's the sense of it. So what are the rules? These are the three rules of Elliott wave analysis, and essentially they are rules of an impulse wave. So when you are marking, you're marking 1, 2, 3, 4, 5 and ABC. Anything which does not fit 1, 2, 3, 4, 5 ends up being ABC. And the rules are just this, that wave 2 never goes below the low of wave 1. Now that's natural. If you think of a higher top and a higher bottom, you want the trend to be in your favor. And if the trend is to be in your favor, you've got to make a higher bottom which is higher than where you started in the first place. So when you do start doing that, you mark the first move as wave 1 and then the pullback to the higher bottom as wave 2. Now that's natural and simple to understand. The second rule is that the third wave is never the shortest. Now, this rule is often misinterpreted. A lot of people think it means that the third wave is the longest. Now, it does mean that third waves tend to be longer than first waves in many situations. However, that's not always the scenario. Many times you will find that the third wave can be shorter than the first as well. However, in that case, the fifth wave will also be shorter than the third wave. In other words, the third will still not be the shortest. So all a shorter third means that the fifth is going to be shorter. So that is the alternate scenario in which a third, and the third can also be equal to the first. So it need not be longest. So that's the wrong interpretation. But what it needs to not be is shortest. So you cannot have a first wave, then you have a third which is small, and then you have a fifth which is very large. So that is definitely not uh, allowed in your Elliott wave marking. So that's one way of actually eliminating what's not a third wave. The third rule is that the fourth wave never goes back into price range of the first. Now this can be a little difficult for people to digest right at the go, but if I simply just try to explain it here, is what we are really saying. Sorry. What we are saying, if this is the high that wave 1 made over here, okay, then wave 4 essentially cannot go below the high of wave 1. Okay, so that's the simple thing we are saying. Okay, so that's what it means, that the fourth wave cannot go into the price territory of wave 1. And if it does, then we cannot mark it as 1, 2, 3, 4. And that allows us to then also eliminate what is an impulsive wave and what is not. Otherwise, you'd end up marking anything as 1, 2, 3, 4, 5. Anything that you see moves, you would say it's 5 waves, but it need not always be. There are other possible patterns in Elliott wave analysis. But what you essentially need is that 1 and 4 do not overlap at any degree of time, anywhere, whether it's the smaller 1 and 4, larger 1 and 4, they don't need to overlap each other. The fourth wave should make a bottom that is higher than the first, is what the last rule is really telling you. Okay. So that I think is the essence of Elliott wave analysis. Won't go into more detailing. Okay, there's a lot of application of Fibonacci ratios to make projections. So you can actually once you're able to mark the 1, 2, 3, 4, 5, then you can actually start making projections for third waves and fifth waves using Fibonacci ratios. So that goes much more detail into how we really do it. But when you understand this picture, the first thing is, I think once you know the rules, what you would be able to do is you'll be able to eliminate bad analysis, because you can end up marking waves anyhow based on your imagination, and then give it any result that you really want. But once you have rules in place, then you can actually eliminate what is not right. So when you're reading analysis of any Elliott wave analyst, if you're reading online, the way you will know whether he's doing something right or wrong is by looking at these basic things, that is he marking the fourth which is falling into the price territory of one? Is he marking a third wave which is shorter than the first, and is the shortest within the entire impulse structure? And are you really getting impulsive moves in the direction? Second is, you'll actually know where you are in the progress of this entire move. So if you're in wave 1 and wave 2, you are able to actually project that you're going to get a third wave up, which is a higher probability outcome. You also be able to understand when I write a post, say for example, if you're reading any of my posts online, and I do publish on social media as well, if you want to start following there, then moment I say that okay, this move is starting a third wave, and the third wave could be equal to the first and go so far, which means we are simply saying wave 1 and 3 may be equal as a minimum expectation. Then you know where prices are likely to head. So and you know that the third is not the end of the trend. After the third, you will get a pullback in the fourth, and you expect a fifth as well. So this picture is in your mind, when you're reading someone's work, as to where you're in the overall trend and what you're likely to do. Okay, so I think that's what you should take away from the basics of Elliott wave, which we are able to cover today. And what I'll go into now is I'll look at what is the reflation trade and what I've talked about, and we'll try to look at some of these Elliott wave counts on the Indian indices as well. The Sensex tends to have a lot more data than the NSE, in fact. But if you really need more data, I think if you really have to do deep Elliott wave analysis at a super cycle degree, you really need to date back all the way to probably 1940. So that's something that I've had a look at only in one chart, which involves backdating of RBI data and so on. So that I've actually published on my site, and that allows you to see it in a different perspective, because a lot of people would start thinking that because if this is the only data, the way even we started out when we were doing analysis is we ended up marking the year 2000, which is out here, as the first wave in the entire progress of the Indian market. And then we thought that after wave 2, longer term, so you had been through a long consolidation phase in the 1990s, and when you got this last bear market, then it looked like you'd probably start a third wave of multi-year. Now you have a multi-year bull run here, but there's a reason why this is not 1 and 2, and why I end up marking this as 3 and 4. Part of it has to do with the quantitative cycle or the long wave. In my presentation, you saw there was one third man in the PPT who I didn't really tell much about, and that man is actually Nikolai Kondratev. For a second, I'll just show you. So you see this third person here is Nikolai Kondratev, who was actually shot dead in 1938 because he was a Russian economist, and he ended up writing about the long wave, which they thought was maybe more a capitalist theory, and they thought probably he was not not communist, and so he but then his theory got picked up, his work got picked up. It's definitely not related to only a single economy. It can be part of any economy, and his work then has become the basis of forecasting long-term economic cycles. And then I mapped that along with what is happening on the Elliott wave cycle as well. So what his theory does is it actually breaks up the entire economic cycle, which exists throughout a super cycle in the market, into 4 phases. He calls them the 4 seasons. So it basically goes through spring, spring, summer, autumn, and winter. So the spring is essentially the start of the bull market, when you start from a completely base or low point where there's no economy, and then you grow from there. Things start to improve, start picking up, and then you get the high growth phase, and that continues all the way till you hit a bottleneck. You hit that bottleneck because after all the high growth, you end up getting high level of inflation. Now, some of that high level of inflation may have to do with over investment and a lot of money circulation, but it actually has to also do with something sometimes on the demographic side, which is a society which goes from being young to having kids, and then a lot of demand picks up in because of the demographics as well. Because as growing children, you have various expenses and spending cycles that cause demand for different kinds of items. So when you get this inflationary spike at the end of a 30, 40, 50-year bull run, which is called the spring, which starts from a point where the economy was completely in doldrums. That point, you also get eventually high interest rates, because you raise rates to actually control that inflation, and eventually inflation does come under control, and you get what is called as the economic summer. This is an important aspect to understand. Okay, and I'm just going to go back to my charts. So it's an important aspect to understand, because through the 1990s, from 1992 to the year 2000, we went through what is known as an economic summer, and that's something that the US went through in the 70s, because that's when they had high rates of inflation and they almost raised interest rates to 20%. We also raised our rates significantly. Bank FD rates had almost reached 15% in 1996, for those of you who've not been around that long. And in fact, AA plus or B plus rated paper would actually end up being at 20% to 21%. So that's how high interest rates were if you were a borrower who was not highly AAA rated. So it was really expensive. A plus would end up at 18 to 19%. So that's where interest rates were. And that's typically seen in what is an economic summer. An economic summer, to me, when it comes after a significant bull run or a growth phase, is actually the end of a third wave and not the end of a first wave. So this is an important part. And if you see my other chart, which is not here, then you probably understand it too, that you had a long bull run from at least 1930s. India had a bull market. In fact, the RBI was instated in 1934, and I would say that the Indian bull market actually starts from there. So that's the spring, which goes all the way into 1990, and then after that you have the summer, which is the cooling period. At the end of the summer, by the year 2002, you had low interest rates and low inflation, and that's what usually triggers the autumn bull market, where you're able to borrow money and grow again at lower rates. And that's what this whole cycle has been about, being able to grow at lower and lower interest rates. Initially, interest rates did come down, then they moved up through the first phase, and now we're actually able to lower them once again, is what we're actually experiencing over the last 6 to 8 months, or rather I should say last 1 to 2 years, because the RBI has actually been cutting interest rates since 2018, once the IL&FS crisis came on board. And so they've been trying to bring rates down since then. They were not able to do it for a long time, till December of 2019, when they started the LTROs. And that's an important part of putting the cycle with this together, because that's when they are able to start getting rates down to levels they've never been able to do before. And the most recent slowdown because of the pandemic is allowing them to take that even further. What's interesting in that is that once you cut rates to extreme levels, what you're really doing is extending the current bull market, which could have really ended. So for a long time, I thought whether this fifth wave is ending during this phase, because you also had what we call Elliott Wave wise an ending diagonal. Okay, so I'm going to just expand this chart a little. Okay, so an ending diagonal is an ending pattern. Of course, I've not discussed all patterns in Elliott wave analysis, and typically occurs in the fifth wave. So at the end of a fifth wave, you get this overlapping pattern, which in classical technicals, and some of you know classical, is also called a wedge. So a wedge is also called an ending diagonal in Elliott wave analysis. It ends in 5 waves. The only difference is that it ends in 5 waves that are overlapping each other. But it has all the same rules. That is, the third is not the shortest. The only rule which is violated is that the fourth wave goes into the price territory of wave 1. This is probably the only setup in which that is permitted. So we end up marking an ending diagonal as ABCDE, which is what I would do for this structure. Okay, and so I'm just doing that right now. So this is how we end up marking an ending diagonal. It has 5 legs, like I said, just like in a 5-wave pattern in that each of the waves, which is the 5th wave, is supposed to break up into 5 waves. In this case, the 5 waves are an ending structure. So that's about the only difference. Okay, so once I mark this ABCDE, what I'm really saying is that this could have ended the 5th wave. However, when we are really going to a higher time frame, like when we are going into a yearly time frame, and now when we see, when we also see, say, where the averages are. Okay, so if I actually plot and I would like to actually go to a quarterly chart. So let me just. What was interesting about this very deep correction? Okay, let me just add the quarterly average. Okay, so now you're looking at the 40 quarter average for the Sensex, and the interesting thing is throughout the even prior cycle, it never really broke below this average. So it ended up taking support here even in 1998. This was the tech bubble which built on top of that. The only time we broke below it was in the 4th wave when you had a larger degree correction. Now after that, throughout this, if I actually draw a line chart, you will find that we've not broken below it, and actually we've pulled back to it here in 2008 and now for a second time in 2020. So the way this has progressed, and because after this sell-off, we've actually been able to change the trend on interest rates, which is the liquidity side of the equation, which is a very important part to understand from the economic cycles part. That I think that what you've actually ended up doing possibly is this ending pattern, which I just showed you a while back, only marks the end of the 3rd wave. Okay, and what you actually have now is wave 4 at this bottom. Okay, so we are really looking at now a 5th wave developing. If I create some space on the upside, what I would be able to do is even make a projection. So one of the ways that we make a projection is the use of channels. And if I draw a channel around this, okay, it's not come out properly. So I'll do that again. Okay, so I really need to take the lows and the highs to get a proper channel. Okay, and so once I take that channel and then I project, if I start thinking you're going to do a 5th wave to the top end of the channel, it will mean the Sensex actually goes to 60,000. If you do the same thing on Nifty, it will go to 18, 19,000 or something like that. Now, right now, given the current environment, that will appear completely insane. But then this is not a trend when you're talking 5th wave, the 3rd wave, and the 1st wave are many years long. We're not talking of a 5th wave that is only 6 months long. We're talking of a 5th wave that can actually last for a couple of years. And so it means about something that will happen much after the pandemic and the crisis is behind us, which we definitely hope should be the case more than a year down the line. But most people are stuck up right now only thinking about what will happen the immediate quarter and the next quarter and the earnings and so on, which is really not what you should be too concerned about. So in the big picture scenario, because this crash happened very, very swiftly, now if it happened slowly, say for example, you fell to, 10,500, then went back to 11,000, then when it came down to 8,000. If it was a slow progression, it would have been like the previous 2 bear markets, like the tech bubble here, the 3rd wave was 1, 2, 3, 4, 5, 6 red quarters before you really made a bottom. Similarly, 2008 was 4 red quarters. Even the smaller corrections here are 4 quarters each. So some people can argue that time-wise, we are still supposed to go down, and so why should the market really go up from here? But the whole idea here is that speed-wise, it's actually gone back to this average, which I've shown you very, very fast, and which is why I think it's possible that you ended up, reaching the worst-case scenario, not just in terms of price, but also in terms of sentiment, in terms of economic activity. Everything cratered into that level, and which is why it may be one and done rather than becoming a 4-quarter slow progressing bear market. It has ended up being a 1-quarter move. The other reason to believe that it's actually, while it looks like only a 1-quarter move on the main index, it's actually much deeper than that, is that a lot of sectors, for example, the pharma sector, ended up being in a 4-year bear market, right? So if we simply take the healthcare index, okay, wait, I'll need to take it on the NSE indices. Okay, yeah. So so what we are looking at when we look at the pharma index, for example, which has been one of the best performers recently, it actually went through a 4-year bear market, which I think has now ended because we've actually broken out of this downward slanting channel. Okay, and my sense is therefore that this is probably going to be one of the better sectors to be in because you've broken out of this. So this is also a fourth wave. We don't have previous price data. If we had the BSE index, you could have seen that. If you're a user of BSE Iris, you'd probably have more historical data. And so we've ended a fourth wave correction and broken out. Okay, as far as the pharma index is concerned, this is just probably the first wave rally. Then you get a second wave pullback at some point, and a third continues. You can even say this is 1 and 2, and you already started third, and keep subdividing and heading higher. If you simply use a simple channel measurement target, also you'll end up at 13,000 on the index. But what this really means is that if you're starting a fifth wave longer term on the pharma index, you're looking at it going to all-time highs all over again. So it'll be a multi-year trend which will probably happen. It's not something which will end right away. And of course, do not think that the speed you got in this first move up will continue. It will probably slow down and go to a normalized speed. That first round of speed came on value buying and probably an allocation to the healthcare sector around the world that drove that buying. But now from here on, it should be a slow progressive move. So point that I was trying to make is that even though the Nifty did not reflect a 2-year, 4-year bear market, many sectors, one, the pharma, second, the auto, so all of these sectors have actually ended up reflecting that they've been through a deep bear market. So we'll also look at the auto sector. Okay. So this too has been a 2-year kind of bear market for the auto sector. Okay. Longer term, it's gone back to the lower end of its channel. Okay, in terms of this entire decline. If you actually take the 2008 low and project it forward, you'll find that it's exactly on that channel line. Wonder if this has these indices here. It had fortunate. So fortunate here we have the BSE index always has more data. Okay, so when you see this entire structure is in a channel. Okay, and what we've completed therefore is wave 1, wave 2. So I would say that this high is wave 1 at the top of what we did in 2005-6, and then it consolidated, eventually sold off in wave 2. And then we got a big move in the third wave, which is also possibly complete. And now what we are looking at is wave 3 completing in 2018. We've had a 2-year bear market now in the auto sector, which is also complete at this point. Okay, so then we are looking at what is a fifth wave. And to me, the fifth wave then essentially needs to go back to the top end of the channel. Now that doesn't, again, I'm saying this doesn't mean today and tomorrow, because you'll say, well, auto numbers are not good. What about COVID? Blah, blah, blah. But the stocks had fallen this far. The index was down to almost 10,000. Now the index is closer to almost 16,000. So it's already done a 50% move. Now, at some point of time, at a smaller degree of time, it will complete 1, 2, 3, 4, 5, and you'll get a pullback. So if news remains bad, yes, you'll get that pullback at some point. But the bottom is made. So you'll make a higher bottom maybe in a wave 2 pullback if it happens. And on a 3 to 4 year time horizon, or whatever the time horizon, what you're looking at is a fifth wave that goes back to the top end of the channel, almost near 44, 45,000. So these are places where the bear market has played out in terms of time, and which is why I don't buy the time argument. Just because Nifty spent time forming an ending diagonal, we believe that Nifty has not been through a bear market itself. In fact, the mid cap index, so here's the Nifty mid cap index, very similar scenario. This is probably wave 1, wave 2, wave 3, wave 4, and you're starting a fifth. And this too has been a long bear market for the mid cap stocks. And while you cannot put the bear market in a channel, what you really do is a bear market usually forms a complex pattern. We mark that as WX, YX, Z, which is also 5 waves, but only they are corrective patterns in WX, YX, Z. And that's what the index has actually ended up completing. So this is a W, then X, then you have a Y, then you have another X, and then you have a Z right in the end of it. So this entire structure completes with this last sell off. It goes back again to what would be a reverse channel, where you take the trend line of the highs and take a reverse line at the bottom. You'll sort of touch there. On the BSE index, mid cap index, it perfectly touches. On the NSE index, you get what is a throw under, which is normal in fourth waves, because when you get a fourth wave throw under, then you also get a fifth wave blow off. Okay, so if I try drawing a reverse parallel channel here, but we're essentially looking at something like this. No. So you don't have this through under if you look at some of the other BSE indices. The other thing you should watch also is the massive volumes that you see at the lows. Okay, and this is market-wide volume, and the market-wide volume expanding into the bottom is a sign of capitulation. So you have, or also we call it selling climax. So selling climax essentially ended up happening here, where a lot of selling took place, which then ends up being absorbed. The only debate is who bought and who sold. So somebody sold, somebody bought, and the volumes reflect that. Eventually, it moves from weaker hands to stronger hands before you get a strong enough rally. So in the very short term, of course, data now is not updated here for today's move, but you actually have a pullback, after which the mid cap index has probably bottomed. It closed positive today, so you had this short term correction. My sense is possibly the short term correction that we were seeing in markets is over, and you start heading up. Okay, but I'm coming back to the basic theory, which is what is the reflation trade? It is the expansion of money and lowering of interest rates. India is because it's 10 years behind everybody else, actually the place where you should see a lot more impact of this reflation. You see the coming back of retail because of lower interest rates, and one of the biggest impacts that has, which is one of the main sectors that benefits from this reflation. Reflation means that central banks around the world are printing money excessively and trying to create liquidity so that you get growth back. That liquidity is trying to end a bull market in the dollar. The dollar is essentially the dollar index, which peaked in 2017 at 104 and made a double top this year in the month of March, almost coming to around 103 on the spot index, but did not go above that. And so this double bottom top from where it is falling is, with all the actions that especially the US Fed has taken, it's actually pushing the dollar down. And the falling dollar has multiple effects. Just like in 2002, it had the impact of money going back to chasing emerging markets, emerging market currencies, eventually commodities and precious metals. Those are the trends I think are likely to play out over the next couple of years, which is and apart from the India centric thing, because we are the only ones where interest rates were much higher and we are lowering them for the first time. So we have that completely different factor in play, where low interest rates create a boom in various sectors, and demand eventually attempts to make a comeback. So that's one thing to watch for. And if nothing else, it leads to a reallocation of money from things like fixed deposits and other lower interest bearing instruments where rates are going down, to equities. And so that shift itself causes repricing of equities and makes them more expensive. And because large parts of the market have crashed, there are actually opportunities in terms of low valuation. So people get stuck up on the high valuation case because the index is up there, but missing out on all the declines that have already occurred in various sectors where the actual opportunities exist. And metals is one of them. So like I said, because why I focus on metals is because it's the reflation trade. this is one of the most important sectors to focus on. Sorry. Okay, so what you have in terms of the metals index also is you had a long consolidation phase. Okay, now if I look at the BSE metal index, you actually see the consolidation all the way from 2008. So it's been through a long phase, and one of the best times for metals is usually when you have a weak dollar and you have strong commodity prices, and that's something that you're seeing. If you haven't noticed, copper prices are up almost 50% since the low that they made in the month of March. You also seen higher oil prices. I think oil, after having hit sub $10, which was a target that so many people had in terms of forecasts. But the funny thing is, even the people who had that forecast have not turned around and said the worst is over, because once you have gotten there, then you're not going to go back to $10 ever again. So you can forget about seeing $10 oil, at least for a long period of time. And so you have a reversal in the commodity price cycle simply because of all the weakness that you get in the dollar, and that makes it the best time to actually be in the metal space. So which is why I'm looking at the metals index. I feel that a multi-year consolidation, I earlier explained that WXYXZ is usually a complex correction that completes in 5 waves. I can't get into the detailing of how we mark these, but what it tells me is that we've actually ended a complex consolidation or correction phase for this sector into 2020, and it's probably starting a larger degree fifth wave. Now it's in very early stages, and till sentiment really improves, people's attention to this doesn't come back, because most people think of commodities as a demand scenario. But when things have crashed this much and you have so much liquidity, the initial move is more on valuation and liquidity rather than the demand scenario changes, which is much more a longer term effect that you'll watch out for. So that's what has started. It started getting that initial leg up. Okay, in the very, very short term, you can actually see, and these are the markings I've done on the NSE metals index for the very short term. A slight impulsive move starting. So you had wave one, wave two. I've drawn channels around it. What you have been forming is a fourth wave triangles. Now triangles are typical of fourth waves, and usually once you have a fourth wave consolidation, you expect a fifth wave on the upside to start. And I think that's what has now begun, or rather is due to begin. Today metals was sort of flat or slightly up, the metal index. But it's at the lower end of this triangle. So my sense is if it holds this lower end, then we're probably starting the next rally in the next couple of weeks, which is a fifth wave that should take us to at least the top end of this channel. If not, go back to the previous swing high. So many times trend reversals will go back to the previous swing high, which means, see, in this case, you will notice that the third wave, well, it's not much longer than the first wave. It is a little longer. So it's possible that the fifth wave ends up being a little more extended because the third did not extend that much. And yes, moves do try to attempt to go back to the previous swing high. So I am wondering whether the next move up will only be back to the channel line, or whether it will be something that takes us all the way to the top end of this swing. And so I think this could be one of the significant movers in the coming days. So far, the recent move in copper prices and some of the base metals have actually not reflected on metal stocks. But in the last 2 days, you've actually seen a rally in a couple of US metal stocks like Alcoa or US Steel. And I think that's a signal that the next move in metal stocks itself may be coming eventually. So that's what I think you should be watching out on an immediate term. Also, do keep an eye on precious metals as an important asset class, because metals is where even precious metals is where you'll get a boom, not just commodity base metals. So precious metals is an important asset allocation that a lot of people don't do. Of course, in India, everybody buys gold, but they don't buy it as a part of their larger asset allocation. So I really don't know if anybody measures whether their entire allocation is 10% or 20% of their savings or 30% of their savings. And one other way of playing it is really using the using something like US precious metal stocks. So they're also known as gold mining or silver mining companies. They tend to move 2 to 3 times the price of gold, and that's a very, very different way to actually play that. So this is what my reflation basically story is, that you're going to see a period of weakness in the dollar. You're going to see in India specifically lower interest rates. So that's driving participation into equities and also driving movements into commodities, metals, and emerging market currencies. And that's likely to get us that fifth wave blow off move, which is slowly building and will slowly continue to build as we get closer and closer to the end of the current crisis. And once it's over, then it's already news, right? So you can't expect to get low prices when the good news is out. You expect to get low prices when there's bad news. And that's something that psychologically or emotionally a lot of people are not thinking. They feel the bad news they're reading in the print today is supposed to push markets down and missing out on the value opportunity that is there because stocks have already crashed. So that's it. I think I've taken an hour into this presentation. We can take a couple of questions now, and my part of the discussion is done. Thanks a lot. Thank you for having me.